Welcome to the channel. I'm the Swedish dividend investor. So, for today, we are going to dust off the old Gordon growth model and do some quick valuations on 5 stocks and ETFs. The Gordon growth model is a powerful tool to quickly get an intrinsic value using just a few inputs: annual dividend, dividend growth in perpetuity, and a discount rate. That means our required return. It's a great tool, but with its limitations. However, it can be used to figure out if we would want to dig deeper into a company or ETF. For those interested, I made a tutorial on how to build this model in under 10 minutes. Link in the description down below. Let's jump straight into it. The first company we will take a look at is Realty Income, ticker O. For those living under a rock, Realty Income is a US-based real estate investment trust, best known for its focus on net lease retail and commercial properties, and its trademarked identity as the monthly dividend company. Realty Income buys commercial properties and leases them to tenants under long-term net leases, where tenants pay most property expenses like taxes, maintenance, and insurance. Realty Income is a member of the S&P 500 Dividend Aristocrats, having raised its dividend for over 25 consecutive years. It owns more than 15,000 properties across the US and parts of Europe, leased to major tenants like Walgreens, Dollar General, and 7-Eleven. It's popular with income-focused investors for its consistent, predictable cash flow and relatively low risk profile compared to other REITs. We got some quick stats from seekingalpha.com, and we can see it's currently trading around $56 to $57. We got a dividend of around 5.5%, give or take. The 5-year growth rate for the dividend is 3.54%, with years of growth being 31. The annual dividend is $3.23. So, switching over to the model, we first enter the ticker O. Followed by the annual dividend, we will use a 10% discount rate or rate of return. I'm going with 4% growth for the dividend. Why 4%? I don't think 2 to 3% growth from inflation and 1 to 2% organic growth is that exuberant. And we get an intrinsic value of 55.99 or 53.19 with a 5% margin of safety. Pretty close to where we are at today. So this is a candidate for a deeper dive. I hope you enjoyed this quick valuation video. If you want to support me, don't forget to like, comment and subscribe. Your interactions really help the channel grow. Next company, Ares Capital Corporation, ticker ARCC. Ares Capital Corporation is the largest business development company, BDC, in the US, focused on providing financing to middle market businesses. ARCC lends money and occasionally takes equity stakes in privately held companies, primarily through secured loans. It earns income from interest payments on these loans. The company is externally managed by Ares Management Corporation, a leading global investment firm specializing in credit, private equity, and real assets. Most revenue come from interest on senior secured and mezzanine loans. They maintain a diversified portfolio across hundreds of borrowers and industries, helping manage credit risk. So, before we check the dividend quick stats, we first see their share price of around $20.5. And looking at their dividend stats, we see their dividend yield is around 9.5% with a 5% growth rate of 3.71%. With 0 years of consecutive growth. The annual dividend is $1.92. Just like before, we switch to the Gordon growth model and enter the ticker ARCC and punch in the dividend of 1.92. Now for growth. It's a hard nut to crack. I think the dividend growth is skewed by higher interest rates. However, long term, the growth could be at 1%. Some years it will be a bump, and other years it won't grow at all. 10% discount rate and a 10% margin of safety. Since this is a bit riskier asset, we get an intrinsic value of 21.55 and 19.39 with a margin of safety. So we are just around the intrinsic value. But I would say I would rather go for the margin of safety one. Sweet! Next one. Let's go with an American ETF. Schwab US Equity Dividend ETF. Ticker SCHD. SCHD is an exchange-traded fund from Charles Schwab Corporation that tracks the Dow Jones US Dividend 100 Index, a benchmark of 100 US companies with a long history of paying dividends. It invests in large-cap US stocks that meet the screening criteria, like at least 10 consecutive years of dividends, plus quality metrics, free cash flow, debt, return on equity, 5-year dividend growth before inclusion. The fund pays dividend quarterly, and its recent dividend yield has been around 3.8%. It has a very low expense ratio of around 0.06% and sustainable assets under management around $70 billion, making it cost efficient and liquid. They are also known for growing their dividend at a high and consistent rate. The current price is around $27 and some change. And looking at their quick stats, we see a yield of 3.9% roughly, 5-year CAGR of 10.38% with a consecutive raise for 13 years. The annual dividend is $1.03. So we punch in the ticker SCHD, the dividend of 1.03, discount rate of 10% and a margin of safety of 5%. Now for the growth. SCHD is pretty famous for their dividend growth. However, I think counting on 10 to 12% growth in perpetuity is not very conservative. Let's go with 6%. Still not very conservative, but their strategy seems solid and they have a track record to back it up. Intrinsic value of $27.3 or $25.93 with a 5% margin of safety. So just around where they are trading today. Now, I live in Europe, and a big part of my audience is also living in Europe, and most of us don't have access to American ETFs. But if you want me to do a deep dive into SCHD, let me know in the comment section down below. Second to last, WisdomTree Europe Equity Income ETF, ticker WTEE or EEIE. WTEE is an ETF domiciled in Ireland offered by WisdomTree that aims to provide exposure to European companies with relatively high dividend yields and quality/momentum screening. It tracks the underlying index called the WTE Edge YE, WisdomTree Europe Equity Income Index, which selects companies in Europe that are among the top 30% by dividend yield in broader European stock universe, then applies risk filters, quality and momentum, and ESG criteria. The expense ratio is around 0.29%. Top 5 country allocation: UK, France, Italy, Spain and Germany. And the sector allocation is mostly tilted towards financials, utilities, industrials and energy. It's a good option if you're looking for European dividend income exposure in a UCITS-compliant ETF for European investors. I've checked their full year 2025 dividend on my broker. There was a small reduction from last year from 0.8105 euros per share to 0.7736 euros per share. They are currently trading at around 14 euros per share. So let's punch that into the GGM, and we also enter the ticker so we can get the current price. For the growth, their 10-year CAGR is around 4%, and their 3-year CAGR prior to this year was around 13%. That 4% growth is along with 2 cuts, with the pandemic cut being over 30%. So I would say we should use the 4% for this calculation, 10% discount rate and a 5% margin of safety. And we get an intrinsic value of 13.41 euros or 12.74 euros with a 5% margin of safety. Again, about where we are. And if that 4% growth plays out, we should expect around a 9 to 10% return. And for the last company, I've gone with a blue chip company, Clorox, ticker CLX. The Clorox company is a US consumer goods manufacturer best known for its cleaning, disinfecting and household products sold under iconic brand names. Clorox makes and sells everyday consumer products across 4 main segments: health and wellness, household, lifestyle and international. Its brand includes Clorox, Pine Sol, Glad, Burt's Bees, Kingsford and Hidden Valley, known for strong brand recognition and leadership in cleaning and disinfecting, especially prominent during COVID-19 when demand surged. Products are sold in over 100 countries, though most revenue still comes from North America. However, they face cost pressures from raw materials and logistics, plus competition from private labels and other household brands. Let's see their stats on Seeking Alpha. Current share price of around $104. Looking at their dividend stats, we see a 4.6% yield, 5-year CAGR of 2.54%, and consecutive growth for 48 years. That's impressive. The annual dividend is $4.96. So we head on over to the GGM, enter CLX and the dividend. Let's go with 4% growth here. Same reasoning as Realty Income. 2 to 3% from inflation and 1 to 2% organic growth. 10% discount rate and a 5% margin of safety. Oof! Far away from their current price. And they have been on a steady decline as of lately. $85.97 or $81.67 with the margin of safety. Let's try to change to 5% growth, even though I think that's a stretch. Remember, this is in perpetuity, as in forever. Intrinsic value of 104.16 or 98.95 with the margin of safety. Ouch. So there you have 5 companies and ETFs you could dig deeper into. I hope you enjoyed this video. Don't forget to like, comment and subscribe if you did. I'm the Swedish dividend investor and I will see you in the next one. Stay smart, stay patient and keep stacking those dividends. Ha det gött!